All right, guys, so let's talk about the loanable funds and government deficits. Remember earlier in the year, we talked about how the government can impact the loanable funds market as they borrow from the pool of loanable funds, which then affects interest rates and subsequently the willingness of consumers and businesses to borrow from that pool. So, as we talk about deficits, let's recall that when the government borrows from that pool, they essentially reduce the supply of loanable funds in the pool and or increase the demand for loanable funds. So graphically, we can illustrate this as a shift to the left of supply or a shift to the right of demand. Both of these things increase interest rates and provide us with an illustration of what happens when the government borrows from the pool. So we had a term for this that we discussed in another video called crowding out. And crowding out is essentially the idea that when the government becomes bigger or borrows money, that pushes out the potential private investment spending of companies and, of course, consumers' access to credit. So if the government takes from the pool of loanable funds and increases interest rates, this creates a stagnation to the ability for businesses and consumers to borrow. And if businesses aren't borrowing, then the long-run economic growth rate in the United States will slow down. Now, the government, when they look at recessions or contractionary environments, the government and the Federal Reserve can either take active stabilization measures or allow automatic stabilization measures to kick in. So if the economy is contracting, the Federal Reserve and the federal government can become active and do something to interrupt potential recessions. So if we're talking about the Fed we know can either increase the money supply to lower interest rates, change the required reserve ratio to allow banks to loan more, or they themselves can lower discount rates to allow banks to borrow more from them. But the Federal Reserve controls the banking system and potential access to credit and liquidity for the banks and the banking system as a whole. So they have those three tools when they become active. The government, on the other hand, can either cut taxes or increase spending. Now, in times of a recessionary or contractionary environment, they are going to most likely cut taxes and increase spending. By cutting taxes on businesses and consumers, that allows businesses and consumers to spend more on the things that they wish to spend on. By increasing spending, the government themselves becomes a consumer. So, by cutting taxes, the C and the I components are affected of aggregate demand, and by increasing spending, the G component is affected. Now, the government and the Fed don't have to become active in order for certain things to kick in to the economy when we go into contractionary environments. For instance, there are automatic stabilizers or safety nets that are built into our economy. So if our economy goes into recession, they don't have to make new law or appropriate new money for these things to take action. What are these automatic stabilizers? Well, they are safety nets that are built into our economy. For instance, we learned in an earlier discussion that as you make more money, the government takes more money from you. That is called the progressive tax system. If you make less money because it's a contractionary environment and your hours got cut or you were eliminated from your job and now you're working an inferior job, you're going to pay less in taxes just by nature of the progressive tax system. So, again, automatic stabilizers, if you're making less, they're going to take less from you. Additionally, there are many different built-in stabilizers such as the unemployment insurance program, welfare, food stamps, or other types of in-kind benefits that exist in our economy that kick in during these times. So again, there are automatic stabilizers and active stabilization measures that allow the government to adjust these recessionary or contractionary environments. Hey, thanks for watching this video. And in subsequent videos, we'll talk about how the government can work to get us out of a recession and how we can illustrate that on a graph.